Welcome to today's update video called Breaking Down Barrier Income. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF, ticker symbol SBAR. SBAR launched mid-April 2025, just over 14 months ago. Today we'll be reviewing performance and positioning for the period ending June 30th, 2026. We believe Simplify is transforming the structured note experience, providing an outcome-based solution focused on income and ETF wrapper. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. I'd like to welcome back Emilio Freire, Lead Portfolio Manager for SBAR. Welcome back, Emilio.
Thank you, Jeff. Happy to be back.
I hope you've been enjoying the World Cup, Emilio. I know you have a strong
For
interest
sure.
in football or soccer for us Americans.
Yes.
Have you attended
Yes.
any games?
Yeah, we went to one of the games in New York, Norway, Senegal, I think it was. It was so much fun with some of the colleagues from the office, and then just enjoying watching Spain mostly, right?
Nice.
Doing well. So playing Belgium tomorrow in the quarterfinals. So yeah, big game.
Excellent. Well, good luck. Belgium kicked the snot out of the U.S.
That's
recently,
right.
so
That's right.
good
Yeah,
luck to your
we'll get
team. All right.
revenge. We'll get revenge. Yeah.
Let's jump right into the presentation. Standard format that we've had in previous calls, but welcome back, Emilio. So just as a reminder, Simplifies has three barrier income ETFs. We crossed the $500 million threshold last week. So these strategies have been around a little over a year, and we're very happy with the demand for income as well as the embedded risk mitigation feature of a barrier option income. So really the three ones that we have on our platform, SBAR. Every position there has a 30% barrier. XV, we target a yield of 15%. And the way we achieve that is through changing the barrier. We've been averaging historically around 25% barrier, but we have had the opportunity to go down to like 22.5% as the barrier. And then XXV launched in middle of November of last year. We're targeting 25% income level, and we use individual securities, roughly about 25 individual securities. The biggest difference there is we're doing a 1 month auto call option. So no real change in strategy or approach. Things are performing as expected, if not a little bit better, given the environment that we've been in. So SBAR more specifically, through the end of May, the distribution rate was 11.76. Just think of it as roughly a percent a month. SEC yield is 3.24. That is going to be a function of what happens to Fed policy and rates. When you look at the performance, Emilio, when I was putting this together, I feel like this is kind of a solution that fixed income historically is supposed to provide is, stable NAV with income. And it feels very comforting to me to know that we're total returns since inception is just under 15% with a vol of just under 10%.
That's
And
right. Yeah.
so these little pullbacks that we've seen in
Yeah.
February through March was the Iran conflict. And then, at launch, right after launch, we launched these right after the tariff tantrum. But the environment for this type of approach has been absolutely great. And, we can expect some volatility based on mark to market of equity indices, but it's really nice to see the total return of 15%. And majority of that is going to be income. Any comments on
Yeah.
the since inception performance here, Emilio?
I mean, I think we can talk more about performance in June, but as you were saying, Jeff, we've been able to deliver really good performance due to all these like short-lived volatility spikes, right? Followed by market recoveries in the market. I mean, in June was another great example of this type of market environment that works really well for SBAR, right? Volatility picked up during the month with VIX going from 15 to above 22, mostly driven by more geopolitical tensions in the Middle East, AI uncertainty, and so on. But these concerns faded relatively quickly, right? So equities recovered most of the drawdown by the end of most of the pullback by the end of the month. So despite of all this market volatility, SBAR finished the month up a percent, what SPX was down about 1%, right? So that's already a relative outperformance of just over 2%. As usual, these spikes in volatility created an attractive opportunity to sell new barrier puts at
Mhm.
higher premiums, right? But also at the same time, the fast market recovery benefited the existing portfolio through, the callability feature. We
Yep.
will talk more about premiums later, but this
Yep.
was, another good example of how short-lived volatility spikes followed by market recoveries can be a supportive environment for the strategy. In fact, one of the best environments probably, right? One
Yep.
interesting point, Jeff, that we will come back to on the next few slides is that while volatility overall equity volatility came down from the mid-month highs, Nasdaq volatility in particular remained noticeably higher than the S&P
Yep.
and Russell, reflecting again, the uncertainty around AI and the technology sector. That divergence was also one of the key drivers of higher premiums. Right? I believe in June we collected premiums above 4%,
Yep.
4.1, 4.2%. So roughly, 10% higher than the historical average since the inception of the product. So, a very, very supporting environment for the strategy. Yeah, once again.
Yep. Again, I'm going to point out that, the fund and ETF will have mark-to-market unrealized gains and losses as the underlying indices, S&P, NASDAQ, Russell experienced drawdown. We did see that in, kind of the March timeframe. Markets went down a lot, roughly peak to trough. NASDAQ was down about 9.5%. The
Mhm.
strategy was down about 4.5%. So the hedging has been effective, and we'll talk about that here in a moment. But
Yeah.
yeah, overall, I think we're ecstatic about the results, and we
Mhm.
like volatility because we can harvest more equity premium from the option
Exactly.
contract. Okay, so moving on here real quick, just monthly income is distributed on the left here. We see a lot of investors using this as a bond alternative, using as a form of alt with a total return focus, and then an equity alternative because it does have that income stream that investors want. Plus, it has this embedded risk mitigation feature of the equity indices have to finish at expiration. One of them has to finish below the 1 year time period of a market index down more than 30%. So again, a rare opportunity that I think historically over the last 35 years, roughly 7.5% of the time any of those contracts would have finished below that 30% barrier, empirically looking at those indices. Nothing really changed here from a client experience. A lot of folks that we've talked to day to day love the idea that our staff is monitoring the positions, negotiating option premiums from different counterparties, completely liquid, transparent. Yeah, it's been a nice win, and obviously with the flows in the portfolio, investors are starting to understand the complexities of an auto call ETF, but they really like the income and they like the embedded protection there. Again, the worst of are S&P, NASDAQ, Russell, 2000, and then the callability is to me, it's a really powerful engine to allow us to stack option premium. As a reminder, that means that from initial value after the non-call period, typically 3 months for S-bar, if the three indices are above the initial value, it gets called contractually, and then we're able to roll that contract into another contract. So let's talk a little bit about positioning, Emilio.
Mhm.
This is
Yeah,
this is
a lot going on here.
yeah. Go ahead, take over from
Yeah, a
this,
lot going
please.
on here.
Yeah.
Positioning summary. I mean, this slide is just a snapshot of where the portfolio stands today. So each bar here represents one of our positions, right? Ordered from the oldest on the left to the newest on the right. And the height of the bars simply shows how much cushion we currently have to the 30% barrier, right?
Mhm.
So overall, we can see that we are in a very comfortable position. I mean, across the portfolio, the average distance to the barrier is, I can see, around 32.5%, and almost 93% of the portfolio is already eligible for auto call, right? It's on
Mhm.
track to be called away, which gives us plenty of flexibility to recycle capital into new opportunities as they arise over the next few months, right? Now, on the hedging side, we currently have one long SPX put position covering roughly 90% of the portfolio. We're actually looking to roll this hedge over the next week or so to increase the notional coverage. But at the moment, the strike of this put is sitting about 20%, 19% out of the money.
Mhm.
As we have discussed before, Jeff, our general philosophy to hedging is to buy protection when we think it's attractively priced, right? Rather than keeping static hedges in place at all times. I mean, for the most part, we will have hedges in the portfolio, but that decision of when to roll these hedges into what expiration, and so on and so forth. I mean, we look at the markets every day. We look for opportunities in the option space every day.
Mhm.
So, that will depend on, internal discussion with the team. But overall, within the portfolio is well positioned. We have a healthy amount of cushion to the barriers. Most positions are already on track to be called away, as I said, and then we continue to maintain downside protection while remaining ready to redeploy capital as opportunities
Yep.
come along, right?
Yep.
Um,
Yeah, that rebound that we experienced at the end of March, and that was a significant driver of a lot of calls in the month of May and June. So
yes,
that's why you see the stock count or the barrier count at 34. I think historically we've been 45 to 50. As of this morning, we're about 44. So as things get called, we have to redeploy that capital for investors. And again, this is a really powerful slide. It's a little busy, takes a little time to digest, but
yeah.
once you understand it, it makes a lot of sense. And we put this
Mhm.
weekly on our website for folks to review and enjoy. Let's talk a little bit about correlations and rates and just
The different
volatility in
drivers.
general. So really
Yeah.
nothing to update here. Emilio, any comments on rates? Who knows what's going to happen to rates? Likely to go either flat to up, but probably not going down anytime soon.
Exactly. I mean, who knows? The point of this slide is just to highlight that the yield of SBAR comes from
Yep.
two independent sources or components, right? The treasury yield and then the income that we generate from selling the barrier puts, right? Since we launched the fund, I mean, we've seen several Fed rate cuts, right? So
Yep.
naturally, the treasury component of the yield has come down, but the more important point is that the options income is mostly driven by equity volatility and market conditions, and that's really the engine of the strategy, right? So
Yeah.
even though rates have declined over the past year, the fund has continued to analyze, as you said, around 15%, right?
Yep.
Which is right around the higher end of our target yield.
Yep. So
Um,
let's maybe move on to the
yeah, let's
volatility.
talk
You had
about
a observation here that I wanted to pull out a little bit more. So we see the
yes.
divergence with Nasdaq, and you kind of hinted earlier. I'll let you dig into this a little bit more.
Yeah, I mean, the main thing to highlight in June is that divergence that we're starting to see, the Nasdaq volatility picking up again in June, while the S&P and Russell volatilities remain relatively stable, right? Again, reflecting the uncertainty around AI and the technology sector. That higher Nasdaq volatility has helped us a lot keep premiums attractive, across the worst of baskets, right? Even though volatility in the other indices has been more stable, right? So overall, I mean, we're seeing premium levels above the historical average since launch, right? Which continues to support the income generation of the strategy. We will see on the next slide, right? In combination with correlations, how we can explain this. I mean, for correlations, this is the rolling 3-month pairwise correlations between the three indices, right? Um, the correlations are the second driver of premiums alongside volatility, but the relationship is actually the opposite of volatility, right? So lower
Mhm.
correlations tend to support higher premiums because they add
Yep.
more uncertainty to the worst of baskets, right? It just
Yep.
takes one of these names, one of these indices to break the barrier for the whole structure. So we've seen correlations move up, it's true, a little since the lows earlier this year, but they're still below where they were a year ago, right? So they're
Yep.
continuing to provide a supportive backdrop for premium generation. So when you combine higher implied volatilities, especially in the Nasdaq, with still relatively low correlations, the overall environment remains very attractive for selling new barrier puts and generating income, right? As we said before, one of the most attractive environments possibly for this type of strategy, right? Um,
Yeah. Yeah. I think that's important to point out that vol is good for option premium, and low correlations are even better for option premium because the probability of
right.
one of them breaking the barrier goes up. So you get paid for taking that risk. And I think investors that have used SBAR, we thank you for your trust in us. And we think
Mhm.
we've got people like Emilio and team working on it every day, trying to generate the expectations that we're setting. So anything else, Emilio, that you'd like to highlight from your
No, I think
experience?
we covered most of the points here. Um, yeah, I mean, really happy with the performing as expected, and navigating these environments as we should, right? In
Yep.
a mechanical way, and focusing on the hedging as well. as one of the advantages that we have, right? The ability to hedge dynamically the portfolio, and yeah.
Yep. Okay. As I mentioned before, this is a monthly series where we invite portfolio managers and some of our distribution folks to the table to talk about SBAR. We thank you for your time today, Emilio, and best of luck to your soccer team, and hopefully you get a victory. And appreciate everyone's time
Thank
and
you.
attention. Have a great day.